Tyre stocks have seen a stellar run of late. In fact, this month or this last 1 week, 9 odd days, the moves have been stellar. Now, what I want is to get you a couple of, or 2 or 3 Bloomberg charts, really, charts on the terminal, on the screen as well. One is what the Tyre stocks have done over the last 8 or 9 odd sessions. And this is what Ceat has done, for example. I'm just using this as an example, but Ceat has had a big move, much better than some of the others, but that's about 7 or 8% over the last 8 days. Apollo Tyres has had a significant move. TVS Sri Chakra hasn't had a bad move either. The only one which is missing the party, of course, is JK Tyre, but there are always exceptions. Now, a couple of things that I want to point out within this Tyre rally. If you look at what rubber prices have done, and there is a natural negative correlation to margins, but there is a natural negative correlation that the tire company stocks have found as well. So the next chart will show you how rubber prices have moved vis-a-vis the stock price. Again, I've used Ceat as an example, but I think the others are fair examples as well. And the yellow line at the bottom of your screen is the trend in rubber prices. Compare, this is starting from February or actually January. Compare that, but the move started from February, the downside on rubber prices, and then the consequent upside that we've seen on the stock price of Ceat, but the others are showing a similar trend as well. And then the next chart will show you the fall in rubber prices vis-a-vis the sudden uptick in margins that we've seen for almost all of the companies, at least in Q2. In fact, there are some numbers that we have as well. Just look at the quarter-on-quarter jump in EBITDA margins for the 3 tire companies that I've used as an example. Apollo Tyres, they had some problems in Europe. Despite that, on a quarter-on-quarter basis, a 220 bips jump in EBITDA margins. Ceat, 800 basis points jump in EBITDA margins. JK Tyre was negative EBITDA margins in Q1. They moved to positive and by a huge margin. So 958 basis points jumps in EBITDA margins for Q2. And if indeed rubber prices don't correct too significantly, that's a base assumption that most brokerages are making and most managements are making as well, then these margins could well be here to stay. But guys, 2 or 3 things. It's not just about margins. Volume growth in second half across if you hear the commentary from all the tire majors, volume growth in the second half expected to be much, much better than the first half. There is a cyclical recovery expected in the truck tire replacement market. Remember, it's the largest revenue segment for all the tire companies, not just for Apollo, not just for Ceat. For all the tire companies, this is the largest revenue segment. And this is coming back. It's a bit of a cyclical recovery that we're seeing after 3 years of decline. We've seen that in the numbers of some of the auto component companies. It could well play out for the tire companies as well. And the pricing power in the truck tire segment is much better due to those anti-dumping duties that were levied on Chinese tires. Select segment, but anti-dumping duty on Chinese tires. So this is a possible trigger as well. And of course, coupled with the fact that raw material costs are expected to stay stable in the second half. So, which is why, despite the fact that the stocks are stretched on a valuation front, I think, if I not remember it wrongly, EBIDTA about 10 times for Ceat, much higher for Apollo, and price to earnings multiples of 19 times for a company which subject to the vagaries of commodity plays like rubber and oil. These are slightly steep valuations, but hey, in a bull market, you probably ride along the valuations and don't question them too much until they start to reverse. So I think that's what people are doing. But I must say, while we may argue that the stocks have run up so strongly in the last few weeks, months, days, the commentary from almost each of these tire companies on the conference calls that they had was very, very optimistic about volume growth. So that speaks about the business and margins as well, because all of them believe that raw material costs will not slide down to take them back to negative territory on the margin front. So they expected stable margins in the second half, which would lead to better profit growth as well.
Wow, I think as much a bet on the auto market in India as it is on anything else. Right?
Yes.
And given that we've seen good sales numbers, etc., for the last few months, this sounds promising.